There's been a strategy floating around out there claiming to redirect your tax money into your mortgage in order to pay off debt quicker. Now, I use the old quotation marks because this isn't really a new strategy. It's a strategy that's been around for ages and it's got a little bit of a cheeky marketing spin on it. In this video, I want to talk about the process behind the headlines, talk a little bit about the legitimacy of it, and discuss if it is in fact a tool that you can use to reduce debt and build your wealth. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we are talking about the headlines of using tax to pay out your mortgage. The way this scheme works is that they, first of all, pre-qualify clients by checking that they have a certain level of income, and now that level of income is normally set at around $100,000 of household income. And they also have a principal residence with a loan to value ratio at a maximum of 80%. Using words like pre-qualify makes it sound a little bit more exciting and a little bit more elusive. But really what they're trying to do is they're just trying to make sure that you are potentially a candidate in order to be able to borrow more money, because this strategy relies on borrowing money for property. Once you've been pre-qualified, it's then suggested that you buy an investment property, and you do so using debt. So you use debt for the purchase price plus the associated purchase costs. And the idea is you need a little bit of equity in your principal residence in order to be able to cross-collateralize the loans to allow you to finance 100% plus costs. Now, this isn't necessarily a bad thing, because when you have non-deductible debt and deductible debt, you always try and maximize the amount of deductible debt and minimize the amount of non-deductible debt. Next, because you have borrowed so much against the property, it's going to be a negatively geared property. So what this means is that the expenses which are going out to maintain the property are higher than the income that's being produced by the property. Now, you can use this loss in order to be able to offset other income, such as your employment income. Normally what happens is you take this loss and you apply it to your tax return at the end of the financial year. And basically when the ATO does their thing behind the scenes, they'll realize that you've paid so much in tax, you've got a loss to offset some of that, so you get some tax back when you lodge your tax return. Now, this is where the redirecting tax into your mortgage part comes in. It's suggested that as part of the strategy, you do a tax variation. A tax variation is where you apply to the ATO to reduce the amount of PAYG tax your employer pays on your behalf. This means that instead of getting a large sum back when you lodge your tax return, you get more income from your employer as they are taking out less tax. Again, nothing new, you've always had the option to be able to do this. The additional income you get from your employer, because your tax has been reduced, is then redirected into your non-deductible debt. So you can either use it to actually make repayments towards a non-deductible debt or sit it in an offset account. So there's nothing new about this strategy. Everyone knows that you can buy an investment property, you can negatively gear a property, you can do a tax variation. The reason why this is gaining popularity is because of the wording used around the strategy. Australians, they love property, they hate tax. You add the two together and you got yourself a bit of a marketing bombshell. And I'm not saying this is necessarily a bad strategy either. I personally have an investment property. It's not negatively geared, but we can talk about the reasons behind that at another time. But overall, I actually quite like property investing. What I am against is the fact that it sells a lot of sauce and doesn't talk about a lot of the downside risks. So let's talk about some of the things you have to watch out for now. Negative gearing means you're making a loss from a cash flow perspective. There are some non-cash deductions such as depreciation, but generally speaking, the money going out the door is more than what's coming in. So firstly, you need to make sure you have very strong cash flow in order to be able to support a strategy like this, particularly factoring in things like rent can go if you can't find a tenant or you get a bad tenant. And just because you're getting a tax deduction does not mean it's free. All a tax deduction really does is give you a discount equal to your marginal tax rate. So the only way that this strategy is going to make you money is if the loss that you're incurring after tax from a negative gearing perspective is outweighed by the increase in property prices. So you're really relying on that growth of the property for this strategy to actually make you money. A lot of the time, it is builders spruiking these fancy marketing tactics to potential investors. They will often sell you a block of land on the reasoning that by buying land, you're paying less stamp duty, so your upfront capital costs are lower. They will then sell you a house to build on that land on the reasoning that by having a brand new house as your investment property, your non-cash deduction, so your depreciation, is going to be higher. But this is where the builders generally make their money, on the sale of the land and the build. For me, these benefits of buying land and building a house are often outweighed by the additional costs and time that it takes to build. So while you're building the property, you're gonna have debt, you're not gonna have any income coming in, so that's a negative from a cash flow perspective. Building budgets can blow out all the time frames blow out, so it can be a costly process. Me personally, I prefer to buy something established, which you can get tenanted on day one, and you know exactly what you're getting. Also, you can focus on getting a little bit more of the value of the property in the land rather than the house, because for me, the land is what's really going to drive capital growth over the long term. You need to make sure that you are staying on top of your tax variation. Over time, your property should become more positively geared, and if you don't adjust the variation, you will end up with an unexpected tax bill. You also need to be very wary about being oversold on promises about how this strategy is gonna make you filthy rich. I was speaking about this the other day with a colleague of mine, Luke, who I know watches these videos, so thank you, Luke. And he was saying that they had one of these guys come into their office one time. He's a fellow financial planner, and this was in a previous life. So they came into the office and they ran them through what they run through the clients. And he was telling me that they do all this financial modeling, which modeling is a great thing. We love modeling. But what they do in their modeling is they assume high growth rates, high rental yields, and of course that makes the strategy look very good. But then what they also do is they compare it to a base case scenario where instead of investing and paying off debt, the clients just spend all of their surplus cash flow. And of course, when you compare scenarios like this, one is going to show millions of dollars in front over time, and the other one is going to show millions of dollars behind. And they will sit there and they'll say to you, if you don't sign on these dotted lines now, well then you're basically saying no to millions of dollars. Now, first of all, whenever you see numbers, you need to understand the inputs behind the numbers. For me, modeling is perfect. You always need to do modeling around financial strategies, but that modeling needs to be based on conservative assumptions, and you need to make sure it is a like-for-like scenario. Secondly, whenever someone over-promises and it looks really good, you should generally run for the hills, because typically it's gonna be a bit of a trap. There is no one single way to get rich quick, unless you buy some random asset like crypto when it's very young, or if you build a business or something like that. But generally speaking, you're not gonna get filthy rich overnight with a strategy like this. And finally, be very careful about relying on negative gearing. The Labor government has had their eyes on abolishing negative gearing for a while. And if this happens, you need to have adequate cash flow to run the strategy without a tax benefit. Now, for many people, this would crush their financial position. So there you have it, the strategy or the workings behind the headline. Now, just to reiterate, I am not against property investing. I actually really like property investing. It's got a lot of pros and it's got a lot of cons. What I am against is when the sizzle is oversold and the risks aren't adequately considered. So with any strategy like this, I would highly recommend you speak with a licensed qualified financial advisor, because then you're gonna get some unbiased advice. But that's it for me today, guys. Thanks a lot for watching. If you like this video, please give it a thumbs up, and I will see you guys in the next one.